Hi, Joe Kehrig with your San Ramon Valley update, and this is the week of October 16th. And today what we're going to go through is kind of a third quarter update. You remember we did a second quarter and a first quarter update. Well, this is your third quarter update. So let's first talk about inventory. So as you can see, the annual inventory of homes for sale, the average, it's funny because people talk about the inventory really going up, and you can see during obviously 2007, 8, 9, 10, 11, it was way up there. Then it's been going down and down and down. But actually where it is right now with the average annual inventory is actually as low as it's been, except for 2021 and 2022. People talking about all this new inventory, which it is rising, that we'll talk about later, but it really is still low like we've mentioned before. And anytime we talk, we're going to make some comparisons to 2017, 18, and 19, because I will tell you, comparing anything to 2021, 2022, the first half of 2022, what do we call that? We call that our unicorn years. And so it's hard to compare with that because everything's going to look less or not as good as those unicorn years. So look at the single family housing units completed. You look at the average annual units completed, and then look what happened. We talked about this for 14 straight years. It was below a 52-year average. So literally over 14 years, we built 6 million homes less than we would have built it. And now they're talking about we're being about 7 million homes short. Well, that's because they just haven't built them for many reasons. Coming out of the recessions, a lot of builders went out of business. The regulations got tough. Lumber mills went out of business. So it was hard to get lumber. The supply was tough to get. But literally, this is one of the things that have affected the supply on the market, is because 6 million less homes have been built since the great real estate recession. And here's something interesting. Today's homeowners are staying in their houses for an average of 9+ years, 9.3. Look at basically from 1985 going to 2009. The average was 6 years. Now it's over 9 years, 50%, more than 50% higher. And you know what you're going to see? Because people are locked in with this 3% interest rates, we're probably not going to see in my real estate career again. They're locked in, so they're not selling. That's what we talk about. You go down basically the street, and you're not seeing for sale signs, you're seeing contractor trucks. Because people are going, hey, I have a 3% mortgage rate. I'm not going to move. We're going to actually dive into that in a little bit. So look at the listing count is low in every category compared to the last 3 normal years. Now this isn't 2020, 21. This compares to 2017, 18, and 19. And you see new listing count, active listing count, and total listing count is way below what we would consider the normal years of 2017, 18, and 19. So even though inventory has risen, we're still well below what would be normal for a normal year. It's funny because you are starting to see inventory tick up. Look at this graph. You can see when we start hitting October, the new listings basically start diving down. Well, we're actually going up, which is a good thing. We need more inventory on the market, but it's not so much that a lot more homes are coming on the market. It's just the buyers are starting to stay away a little bit because of the 7.5% interest rates. So the nice homes and the desirable areas that are priced right are selling and getting multiple offers in a lot of situations. But man, if you're not in a great area or it doesn't show well or you're overpriced, you're sitting and you're probably end up going to do a price reduction. So what about home prices? Well, you can see that sellers always thought that, the average Americans thought going back to January that 37% of them thought that prices were going to go down the next 12 months. And it literally has gone down, 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 down to now July, 24% of the people feel that prices are going to go down. And where they've actually ended up going up this year overall. But still, so the sentiment of Americans feeling that prices are going to go down as interest rates went up, they don't really feel that way anymore. Look at these indexes. The Case-Shiller index, the FHFA index, the CoreLogic index, and then you go to the next slide, the Zillow, Black Knight, Freddie Mac. You can see that they did go down. So the price change in home values, you can see that they were way up over in 2022, the unicorn years, the first 6 months of the unicorn years, and then you saw them go down for the second 6 months of 2022. But look what they've done 2023. they've steadily have gone back up. Like we talked about, overall, we lost 20% equity in our 20% valuation percentage in our homes. And in some areas, we picked up the whole 20%. And in some areas, we picked up at least 10 or 15, but the market has definitely come back. You know, look at estimated home price performance, December to December, as forecasted in Q3 of 2023. So they expect the prices would have gone up 3.32% if it carries out this year, which is going to be about 3%. They think in 2024, it's probably going to go down to just about 2%, 25 back up to 3%, almost 4% in 26, and then back up to over 4% in 27. So they're seeing that maybe the estimated home price performance will go down a little bit, but then it's going to go back up. But the one thing to notice throughout all of this, they're all in the positive mode. No one's thinking that prices are going to go down. Look at mortgage rates. You know, the funny thing is this lock-in rates limit new inventory like we talked about. You know, when you have a less than a 3% mortgage, you can see the pie graph here. You're not selling, you know, unless you have to, divorce or downsizing. We just did a Prop 19 seminar, which we'll be doing more. If you need any information on Prop 19 on transferring your property taxes, you know, the reason that law passed is to unlock some homes that people were sitting in for 20 plus years, two-story homes. And now they can transfer any place in California their low county tax rates. So, but you can see between, you know, from under 3% to 3 to 4%, which is 71% of the loans out there, they're not selling, or they're probably not selling. 4 to 5%, they must think hard before selling. And then 5 to 6, yeah, they're probably going to sell, and they're more than 6%, yeah, they're probably selling. So that's why we have, one of the reasons we have a lack of inventory. That and the fact that millennials are in their peak of their buying season because we didn't build enough homes the last 14 years. So there's a lot of different things contributing to that. Look at 70.7% of mortgage rates are less than 4%. There's only 3.7 that are above 6. That's why you see a lot of lenders going out of business, because if your business as a lender was refinancing, you're not doing a lot of refinancing right now. So mortgage rates are less relevant to older homeowners. This is the reason that we're doing a lot of Prop 19, because what happens if you've been in your home for over 20 years and you have a two-story home and you want to downsize, well, you have a situation where chances are when you downsize or you move out of state, you're going to pay cash. So you don't really care where rates are. And you can see with 35% of the baby boomers, the interest rates doesn't affect them, but it goes all the way down to millennials of 14% because they're definitely getting loans, and it definitely does affect them. The other thing that people talk about foreclosures is, yeah, you hear about, oh, foreclosures have doubled. Yeah, they've doubled since 2021 when you couldn't foreclose on a home. But they're still way, way below during a normal type year. They're less than half what they were during the 2017, 18, 19, the last normal years. And this is the reason why. 50, you know, when you sit there and say, when you look at the Brown, 38.7% own their home free and clear. And then 30% have mortgage rates, have more than 50% equity. So right there, you have almost 70% of the people that have 50% or more equity. And then you basically go 30 to 50%, even 10 to 30%, they're not getting foreclosed upon. It's only, that small pie of 0.12, 1% of the people have negative equity in their home. So that's why you're not going to see the foreclosure wave of foreclosures. Every home that's in some point of foreclosure could come on the market tomorrow and we'd still have a lack of inventory out there. Look at inflation in the 30-year fixed rate mortgage. This is where we're kind of, the Federal Reserve it's tough because what happened is they came back to us and they sit there and say, inflation's out of control. So we need to lower inflation, and then we're going to raise the interest rate to lower inflation. And then, but look when you look at this chart, inflation has gone down by half, more than half, but yet mortgage rates continue to go up. Why? Well, now the Federal Reserve is basically saying, well, the unemployment is at an all-time low, so if people are working, they're going to spend money. Because what happened in the Great Recession of 2008, they basically raised the rates to stop the inflation, and then they lowered it, but they lowered it too soon, and they put us into a second wave of a recession. So they're very careful with the rates now to lower them too quickly. So even though they told us if we lower inflation, they'll lower the rate. Well, they lied to us. Now they're using the excuse of the unemployment being at all-time low. So you can see mortgage rates 7.18 on an average going through. You can see over the graph when you basically go back from 2016, obviously, and then the low of 2021. Mortgage rate projections. So this is what basically Fannie Mae, NBA, and NAR are thinking. So they're expecting on the average to be about 6.5% for 2023. So they are expecting it not right away, but to go down. Then go down to almost 6%, a little bit lower than 6%. And then, so they expect it not going back down to 3%, but over the next 3 years, they're thinking we might be somewhere between 5.5% and 6%. It's kind of what I'm thinking too. That's kind of where we're going to end up sitting. And because of the supply and demand, with there being no supply, you're going to see the market take off. Just anytime anybody sees any lowering of interest rates, you're going to see the market take off. Because remember what happened in February of 2020, it was the best February we had in 13 years. Then what happened in March 2020? We hit COVID. So after we hit COVID, we went into a huge recession, obviously, with people being out of work, businesses closing. So they dropped the interest rates down to 3%. We're literally, from a real estate standpoint, we already had the hottest market in 13 years. So when we came out of the lockdown with COVID at 3% interest rates or less, it was literally like pouring gasoline on a fire. That's why we had those unicorn years of 2021 and first half of 2022. And you can see the mortgage rates, what they're anticipating, the low of going back to 2018, the high really 2023 projected, and then obviously coming down in 2024 down into maybe the 5.5% to the 6% range. So what's going on with our market? Well, kind of just like we're seeing nationwide. Look at San Ramon. The last couple of weeks, you've seen inventory rise, but the pendings are still doing really well. There's still more pendings than there is active properties. And like we talked about, if there's half as many pendings as active properties, you have a situation where it's a seller's market. When you have more pendings than actives, it's really a seller's market. But again, it's a tale of two markets. Priced right, shows nice in a nice area, it's getting multiple offers. And if it doesn't show nice, or it's not in a great area, or it's overpriced, it's not selling. The reason why is in 2021, first half of 2022 at 3% interest rates, people were willing to pay, they were willing to buy anything. But at 7.5%, they're not willing to overpay or buy something that needs a lot of work. Danville, you can see inventory coming down a little bit, pendings coming down a little bit, but still a strong market. Blackhawk is basically kind of even. But remember, when you look at Blackhawk, you have a situation where, during the 2008, there were 200 homes on the market in Blackhawk, about 1 out of every 10 homes. But once we got down to 50, anytime we got below 50 homes on the market, we would consider it, there's not enough inventory. We got down into the unicorn years where there were like 3-4 homes on the market in all of Blackhawk. Now people go, okay, inventory has risen. We have 19 homes on the market in Blackhawk, but that's still less than half what we would consider for even a slower amount of inventory. Alamo market, you can see, obviously, just like we're starting to see, actives go up, pendings go down. The unusual part of this, you normally see active properties go down, but what's happened, it's not that there's a lot more hitting the inventory. The buyers have just got interest rate fatigue, and they've kind of pulled back a little bit, hoping maybe interest rates go down. But like we talked about, this is a great time to be a buyer because there's inventory out there, prices are being reduced. Marry the home, date the rate, get into a 5-year adjustable. And then in the next couple of years, it will go down. Basically, then you can go and refinance. Or get into a buy down. Ask the seller for a 2-1 buy down. Buy the interest rate down 2% the first year, 1% the second. And by the time you get to the third year, chances are rates are lower that you can refinance. Dublin market staying pretty steady, though you see actives go up, pendings go down, so that's kind of consistent. But when you go and you look at the sold price, the list price, we're still sitting about 100%. Now, I will tell you, a lot of those have price reductions tied to them. So if we look at where they started, it would probably be around 95%, but still a healthy market because there's a lack of good inventory on the market. So if I told you it's a good time to be a buyer, it's a good time to be a seller if you're priced right and your home shows nice. Like I said, in any situation like that, always reach out because every house is different, every neighborhood is different. But reach out, we'll sit down with you. Deciding to sell or buy, 80% of the pieces of the puzzle are personal. But the other 20% we can give you so you can make whatever decision is best for you. Give me a call, Joe Kehrig, 925-487 212-222-6838, or drop me an email, joe@kehrigteam.com, or visit our website to watch 3D walkthrough tours of any of our homes, www.kehrigteam.com. Have a great week, and we'll see you next week.